Assalamu alaikum. Hello and welcome to Gurukul Online Learning Network. Today we are going to study finance and banking. Your instructor Sheikh Mahadi. So our today's topic of learning is these three: concept of stock, concept and features of common stock, and advantages of common stock. So first of all, let's take a look at what the concept of stock. What is stock basically? So stock is a type of security that signifies ownership in a corporation and represents a claim in a part of corporation's asset and earning. So what does that mean? Stock, preferred stock, share stock, common stock. Stocks are named as share. It's a security ownership in a company that represents and claim a part of corporation assets and earnings which are given to the normal regular publics. Stock allows investor to own a portion of a public corporation. So as I said, the general shares and stocks both are the same thing but with two different names. Shares are the share or stock. Stock are the small portions of a company, small dividends of a company. If you buy a share of a preferred company, the general shares that are releasing or being held out in the markets, if you buy that, you are a small owner or you hold a small portion of that own company. That means you are a small owner of that particular company. So initially that it is sold by the original owners of the company to gain additional funds to help the company grow. This line means when a public administration or a public company sells their share, they sell the share with a motive to earn more and more capital for their company. Suppose your company has 1 crore taka of investment or capital. Somehow they need 2 crore of investment. For 2 crore of investment, they will release 100,000 or 100 shares of each taka, 10 lakh, 1 lakh. That depends on the number and the value of share. Within the general markets, the share will be sold, and when the people will buy it with the defined given share value or the share price at the market range. So that's how the more and more capital will be capital inflow will be more and more towards that company. So that's how the owners of the company sells shares and gains additional funds for the company to grow. This is called initial public offering, or for short IPO. The owners basically sell control of the company to the stockholders. That means stockholders or the shareholders, both are the same. The company gives out the shares or sells the share, they just literally gives the control over to the shareholders. That means the shareholders can decide, shareholders can meet up, shareholders can say whatever they want. If they have some kinds of opinion, they are seeing some kind of advantage or some kind of disadvantage, what should be done or what not to be done. Those kinds of things are given in the hands of each and every shareholder who buys those stocks. So after the IPO, the shares can be sold and resold on the stock market. So what does that mean? Suppose I just bought a share and I don't want it anymore. I can let it sold it on the stock market or to someone else, or even return it to the company in some few certain cases. A holder of the stock or to be shareholder has a claim to be part of the corporation's asset and earnings. If you are a owner of a company, you will automatically have your claims over the assets and all the other earnings or the liabilities or the profits or the debts of the company automatically. In other words, a shareholder is a owner of the company, a small owner of the company, but not in the largest section. So ownership is determined by the number of shares a person wants to relative by the number of outstanding shares. So ownership is determined by how many shares that person has purchased. The more the share he's purchased, the more the owner of the company he is. Someone bought 10 shares and someone bought 1 share. Those two are not equal. The person who bought the 10 shares is the biggest owner, and the one who bought the smallest one, that means the 1 share, is the most smallest owner of the company. That means both of them are owner, but their spaces or values different from each other. So that's how, for example, a company has sold 1,000 shares of stock outstanding. One person who wants 100 shares, that person would have claim of the 10% of the company's total asset. 1,000 shares were released, 100 were bought. 100 were bought by one single person. That means he alone is the 10% owner of that particular company. So there are mainly two types of stock: common stock and preferred stock. That means the shareholders basically. But shareholders are persons, but the people who are buying it, those are called stocks. Common stock usually entitles the owner to vote at a shareholders meeting and to receive dividends, which means it is the general share. When people buy a general share, they get the company's profit, liability, debts, whatever you say. If the company incurs loss, that loss will be divided equally among all the general shareholders or the common stockholders. If the company is facing a very big liability or very big loss, all the loss and the liabilities will be divided equally among all the shareholders. That means all the common stockholders. But in case of preferred stock, generally it does not have voting rights, but has a higher claim on asset and earning on the common shares. For example, the people in the common stock or in the general share, they get not equal dividend. Sometimes they get more, sometimes they get less. It always depends on the company. But and on that other case, the common stockholders do get to participate in the meeting or the voting rights or the discussion, which will be benefited for the company or not. But the preferred stockholders, they have a higher claim on assets and earnings on the common shares. They have a specific amount of profit hold, that if the company, if it faces loss, they have to pay the same amount. If it is going in profit, they have to pay that same amount too, and within the profit percentage, more the amount of that. So that's called the preferred stockholders. So for example, owners of a preferred stock receive dividends before common shareholders have priority in the event that a company is going bankrupt or liquidated. So as I said, it's a very formal line to be said, but for understanding, that's it. If, as I said, the company, even if it's facing loss or even if it's facing profit, the preferred stockholders must be paid the amount which was given or which was promised to them. So that goes the concept of stock normally. So let's talk about the common stock. What's a common stock? Common stock is a type of security evidence that serves as evidence proprietary ownership, initiate proportionate voting rights. It gives its holder an unlimited proportionate claim on the assets and income of the firm after the claims of leaders and obligations are satisfied. So let's just explain these few sentences in one word. Common stockholders will get unlimited profit and unlimited liabilities. Why? Because they do not have rules and regulations bound within the like the preferred stockholders. Within that, they are not bound to do anything. They are bound free of profits and liabilities. They go in meeting, they give off decision, they give off opinions. Sometimes they do not even match off their opinions. Sometimes they think it's a meeting where they will say it's good for the company, it's bad for the company. They just simply get to decide whatever the company is going on. They are actually, or they're literally immersed within the company's internal affairs. That's how they can get a higher amount of profit or sometimes a higher amount of loss more than the preferred stock. Preferred stockholders have a certain amount of proportion that has to be given to them or must be given if the company faces loss or not, even if it's going liquidated or even if it's going bankrupt. But these common stockholders will get their profit after the main claims of the leaders. That means the main owners of the company has been satisfied, then they will be given their profits. Common stock continues the equity of capital of the firm, which is never paid back and lost if the firm fails. So common stockholders do not usually get their invested capital. It's very risky, and with that it is very profitable. Like if a company is going in profit, you will be very much profitable within a very short amount of time. But if the company is going bankrupt and totally dissolved, your entire capital will be gone with the whole company. That's why I say that firm which is never paid back, the main capital of the shareholders which is never paid back in case of common stock. The common stockholders are one of the bottom priority ladder for the ownership structure. In this event of liquidation, common shareholders have rights to company's asset only after bondholders or preferred shareholders and other debts had been paid in other full senses. So, features of a common stock. As we said, we have mentioned features of common stock in ins and outs, pros and cons sometimes, but let's take a glance at the main features of the common stock. Those are right to income, right on assets, control, right on share, limited liability, sometimes unlimited investment, sometimes unlimited profits or unlimited liability, nature of ownership, then different kinds of things. But let's start discussing those. Right to income. The common stockholders have a residual claim on the income of the company. After giving all the charges and costs borrowed from the fund, remaining balance is entitled for the common stockholders, which is a very advantageous point for the stockholders who are just in common or general sense, general common stockholders. Right on assets. Right on assets, the common stockholders has the most right on assets and other earnings of the company than the other debtors or the mortgage payers or the bondholders or the preferred stockholders. In that case of debtors, in case of liquidation, all the remaining assets of the company are entitled for the common stockholders, as I said earlier. So, right to control. The common stockholders have the best right to control after the owners, the main owners or the chief of the company, which preferred stock owners do not get. So what does mean by the rights of control? The general stockholders do get to be present in a meeting or the board of directors where they are deciding the future of the company, giving their opinion, giving their valuation, whatever it may be. Preference of right share. If a company wants to issue an additional stock, common stockholders have a legal right to be offered by the company to purchase in proportion of their existing ownership. Let's take a look at that again. Stockholders have a legal right to be offered by the company to purchase in proportion to the existing ownership. That means within the existing ownership, the common stockholders have the right to buy that shares again from them. Limited liability. Although the common stockholders bear a ownership at risk, their liability is limited to the extent of par value of the stock. Suppose I bought a share of Taka 500,000. My liability will be limited up to that 500,000, not exceeding that. If that would be too much for a general stockholder or a common stockholder. Unlimited investment. Common stock has no maturity date, so the stock does not have definite maturity period. What's a maturity period? Maturity period means up to date, when a bond or share that comes up to date, like a business, your business was termed for 15 years and you bought a share at the very beginning of 2 to 3 years. Your maturity date is 15 years. So a common stock do not have any kinds of maturity. It does not mature ever. So you can just keep on investing and keep on taking profits from the company simultaneously. Nature of ownership. The common stockholder of a company, its ultimate owners. Common stockholder of the company is its ultimate owners. That means stockholders are the owners of the company apart from or within the main owners of that particular company. They own the company and assume the ultimate risk associated with ownership. They feel within themselves that they are the owner of the company and they need to think of the company's future and its advantageous sides. Their liability is restricted by the par value of the stock. As I said, investment 5 lakh, the liability is bound within that 5 lakh taka. Advantages of common stock. So these do have advantages and do have disadvantages. So what are the advantages? No obligation to pay back. Common stock is not redeemable. The company does not need to repay the amount it collects through issuing shares. We are talking within the company side, not the shareholder side. We're talking on behalf of the company. That means it's an advantage for the company that they do not have to pay back the money that the shareholder had bought their shares with, not unlike the preferred shareholders or the preferred stock. With the preferred stock, the capital has to be given back. But there are so many disadvantages in preferred stock. We'll talk about that section later on. But secondly, no obligation of payment. It does not involve any kinds of obligatory payment in exchange of fund raised. A company entitles to pay its dividend only after it incurs a profit, giving all the debtors a claim of that profit. So what happens in case of in common stock? That means no obligation of payment like the preferred stock. In preferred stock, whether your company does profit or it does loss, you have to pay them the amount promised to them even before you distribute something among the main owners. And some cases you have to distribute them after, and sometimes you distribute them before the payment of the owners or different debtors, owners, mortgage holders, any kinds of stockholders. Then increase in financial strength. A company's ability to get equity proportion has increased. How? So the lender proportion of the company in common stock capital. When a company releases its general stock to the later on market, the market values of different kinds, the normal public, when buy the shares, they are increasing the company's capital by selling out the shares to the normal or the general people. Limited liability. Limited liability of the stock is limited up to the face value of the security. That means the investor best loses the face value of his investment. That means if an investor invested taka 5 lakh, he will lose only taka 5 lakh, not more than a single penny like that. 5 lakh, 1 taka, no. He will just lose 5 lakh of this investment. That's why they said at best he can lose is his investment. No. Then lower financing risk. Financing by common stock is less risky a source than other financing like debt, preferred stock, because of the threat of becoming defaulter is not present there. Lower financing risk. In this case, the debt or the preferred stockholders, they get only a promised amount of money that has been promised to them will be given at the end of each year if the company makes profit or if the company makes loss. But in case of common stockholders, they can get as much as profit they want if the company is making that much profit. So in that case, very lower financing in case of common stock. Liquid assets. Most stocks are very liquid. In other words, they can be bought and sold quickly at a fair price. Shares are liquid money. Shares, checks, these are called liquid money. These are all hold out in a paper. You submit those, go through some legal documentation, and then you just have cash on your hand. Those are called liquid money. So today we discussed about the concept of stock, concept and features of common stock, and advantages of common stock. In the next class, we'll start learning from the disadvantages of common stock. So that's all for today. If you have any kinds of question and queries regarding this lesson, please let us know down in the comment box below. And if you like the video, please share as much as you can. And thank you for being with Gurukul.